Last week, we talked about why paying cash might not always be the most efficient way to go about things. This week, we're going to talk about the risks of being all in the market at retirement. It's about using high cash value life insurance as a volatility buffer. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And I'm Carlo Viqueira with Netwealth Finance.
All right, volatility buffers are important, mostly because you really got to deal with the sequence of returns risk when we're starting to get close to retirement. Well, let me rephrase that. It's not just at retirement. There's kind of two phases to the sequence of returns risk. Tell us a little more about that.
Well, when we're talking about this, I'm going to talk about the pre-retirement phase when you are in savings and trying to build up that retirement nest egg. So if you have encountered a market crash in those early phases where you take a 30% haircut when you're 25, you still have 20, 30, 40 years of compound interest that can grow on that. You haven't built up a big nest egg. So it's not that bad when you experience that crash in that early phase. And you'll have many more years to have that time in the market rather than trying to time the market. So you can build up that wealth, and over time, that sequence of returns, you can encounter this various times throughout your savings journey, and maybe it happens again as you're approaching retirement. Well, maybe if you're a couple years out, you've saved up all of what you think you are going to need in retirement, and you have it set where you got your 4% rule. You have enough to cover your expenses based on a 4% withdrawal rate and not tap into your principal. And you got the whole plan, but then the market takes a haircut and now you're in trouble. So you have to reduce, adjust, delay retirement, various things like that. And that's kind of the summary of that sequence of returns risk in the pre-retirement phase.
Yeah, and then we have the post-retirement phase. So after you actually retire, now you really need to live on the money that you've saved up. And this is where the sequence of returns can kick you in the butt again. At the beginning of that, you've retired. Maybe you had to delay it because of a prior market crash, but you've retired and you have enough money that you're going to meet your expenses with that 4% rule. And if the market crashes during the first initial years of your retirement, that could have a significant impact on the viability of that strategy at the dollar amount that you were planning to pull out. You're going to have to adjust again. Conversely, if we have that crash happen 10 years into retirement, then you're probably okay. I think most of your Monte Carlo simulations will show success at that same dollar amount as long as you don't get the crashes in the early years of retirement. Well, we don't know when the market's going to crash at any given time. So it's always nice to have a volatility buffer, something that we can reach into that's not correlated to the stock market, and we have access to liquidity or cash that we can meet our expense needs without having to sell everything that we've been accumulating inside the stock market. We don't have to sell it at half price or for a 30% discount just because that's where the market is at when we need it.
And I think that's where this podcast and our strategies that we like to implement comes into play. The whole life or IUL can really, really help in those circumstances when you are going to need to tap those funds, but the market has taken a dive. Neither of those products, the IUL or the whole life, will have that giant haircut like that. In the whole life side, you have those guaranteed growth, and you have on the IUL side that floor of maybe even a floor of 1% when you're using certain indexing strategies. So there's a really good way to tap those through policy loans or withdrawing up to your basis instead of taking out that planned 4% when you need to. So it really becomes a powerful tool for being that volatility buffer when you're encountering some of that sequence of returns risk.
One of the keys to success of life insurance, whether it's whole life or IUL, as a volatility buffer, and I'm going to even throw in annuities with this. Income annuities can also serve as a volatility buffer heading into retirement, so pre-retirement. You've got to plan ahead for these things. So the key to success is planning ahead. If we build these things early, whether you're young or middle age, if you give yourself enough runway, we're going to have a very low expense ratio in these products. That means even though we might not have as much growth as we can achieve if we were to put this money in the market, we get a good amount of growth over a very, very small expense ratio that allows us to essentially have this money sitting off to the side, but not losing to inflation and giving us the funds that we need that can allow us to delay drawing from the market investments when the market is down.
Well, and that's actually a really good segue into something that maybe what your traditional financial advisors or advisors will tell you is as you're approaching retirement, the way that you hedge for this oftentimes is to move into things like money markets or instruments or things like that, where it's not going to have that giant volatility. And in the end, sometimes what that's going to do is really you're losing money to inflation. So oftentimes the plan might be something like have 3 years as you're approaching retirement, have something like 3 years of expenses in there, because generally speaking, you can weather the storm when you have that 3 years of protected stuff, that the funds that are ready to go. But now you're just kind of giving up gains, and that's why I think something like whole life that is just as secure, has great returns, or like James said, annuities, if you have that as part of your overall financial plan, or an IUL, all of those tools can be that same hedge, but they have the benefit of still having pretty good gains or potential gains.
Now, one of the things I like about whole life insurance is we know that over 30, 40 years, we're going to get an internal rate of return from a large mutual company that we become part owner of as the owner of a whole life policy. We're going to see 4 to 5% internal rate of return. Historically, those are really good rates to bank on, and they should beat overall inflation over time. So if we're getting money put into something like that, we know when we get into retirement or near retirement, we're going to see consistent gains that is going to beat or match what your bond rates might be, or what your treasury rates might be, what your short-term safe investment platform might be able to offer you. But you couldn't tell me right now, 20 years from now, what's the money market rates going to be? What's your high yield savings account going to be at? Where are the treasury rates going to be? We just don't know. And if you look back at recent history, those rates were extremely low for a long period of time. So if you're going to bank on setting that money aside into something that might get you 1 or 2% of taxable interest, you're really missing out when you could have been setting that money aside into something that's going to get you 4 to 5% interest in a tax-deferred manner.
And I think we've mentioned this a number of times too. You have that added bonus of there is a death benefit, and the end return of that, if you do pass away early, is even higher. So there's a lot of power in going the route of using these life insurance products. I think whole life is, just as James said, that is the perfect substitute for what might be allocated to bonds. Like I'm not, this is not for everybody to do, but like personally in my retirement accounts, because I have such strong whole life, I have a lot of whole life on my own. So I don't put any of my funds in my retirement accounts in any kind of bond instrument because it just doesn't make sense for my situation, or even for me. And that's not a recommendation for your situation. We can have a conversation about specifics, but that is my approach because I know that I have that solid foundation with whole life.
I'm in the same boat. It really allows me to meet the needs of the safe part of a portfolio in the whole life that I'm contributing to. I also have IUL that I'm contributing to, which gives me a little bit of different exposure, a little bit more upside in certain things that I want exposure to in the market, but downside protection on things that I might otherwise be invested in the market. So I really like that dichotomy. And then I also have annuities that we're working on building up because one of the reasons we're saving money for retirement is we know we're going to need it for income. And that is where annuities specialize in. There's no insurance cost inside of an annuity. So we have a good opportunity to have some good, consistent growth that can pay out a nice income stream no matter how long we're ending up living. We're battling longevity risk with the annuity. And if we start early enough before we get to retirement, we're also trading out some of that market risk for the guarantees that we're going to get on income payout. And when I can make up some of that income need, that gives me a little bit of volatility buffer. Or I should say that gives more power to the volatility buffer of what I'm storing in my life insurance because I'm already meeting some of that income need every single month guaranteed with what's happening with the annuity.
Yes, and we've been talking about this in the context of safety and things like that, but maybe you did a great job in your savings and you have this nice plan and you're actually more in line with potentially having the ability to be at a 3% safe withdrawal rate and cover your expenses. But the thing about it is you're planning for that because you might have some big expenditures that if you want to buy a new car every few years or whatever it might be, that is another area where if the market takes a downturn and you were planning on buying a vehicle and you were going to do a bigger draw one year, well, that's a really good place to just tap that life insurance. And on top of that, you don't necessarily have to do a withdrawal. You can do something like a loan and pay it off, or what you can have various plans that you can do with that flexibility of having those products when you're in retirement. And there's more ways than just the sequence of returns risk in terms of success in making it to through your entire retirement. There are ways that that risk can impact some of your luxury spend that you might want to have or you had planned that you could still do if you have that nice buffer from these products.
Now, the reality is the market, historically speaking, will give you a very, very high likelihood of success if you only rely on the market and what your normal, typical financial advisor might advise you to do with regard to utilizing equities and maybe a bond mix. But it's not 100%. And what I like to look at things is I like to look at it as what is the likelihood of success of the overall plan that we're going to take into retirement. And if we don't have 100%, if we're at 90%, that's not high enough for me. Do you really want to take the risk that you're going to miss, that you're not going to be that 10%? That could be a pretty big risk that you take on in retirement. That doesn't mean that most people won't be successful with it. Most people will, but you've got to decide what happens if you're the one. What happens if you're that 1 in 10 people that it doesn't happen to be successful for? Well, we can switch those odds and make it dang near 100% by adding in a tool that gives us that volatility buffer. Everything gets better when we have enough set aside in an uncorrelated asset. So you've got to be careful when you're just exposed to the people that just espouse all the best things that happen in the market and they're pointing to what happened in the past. Because the reality is we got to deal with what's going on now and what's going to happen in the future. And how are you going to emotionally react to market downturns, to things that are changing in the marketplace? When AI starts to take over everything and suddenly all the jobs are going away, how are you going to react? How's the market going to react? Is it going to continue doing what it's done in the past? I'll tell you what, it always feels like it's different. And historically speaking, the financial advisors are going to say, everybody always says it feels like it's different, but then it does the same thing. But when you're in the situation, it definitely feels different. And some people diamond hand it and can withstand it or ignore it and just let it go, where other people panic. And they end up selling at the bottom or getting out before it goes back up, or maybe in the future, maybe it doesn't actually come back up. We just don't know. So for me, I would sleep better at night. If we have the volatility buffer in place, we took the time to prepare ahead of time so that that's something that we just don't have to worry about. Take that risk off the table.
And I just want to highlight something James was talking about earlier. He mentioned Monte Carlo simulations. He talked about that 90% success rate. That's where a lot of, that running those simulations is something that people will do to see how they'll be successful. I think we've mentioned it in a prior episode, but I believe it was an Ernst & Young study that incorporated the things like permanent life insurance and annuities into an overall financial plan. And it is their study showed that overall success rate being higher when you incorporate a blend of these things with your more traditional retirement accounts. And I think that that's really powerful to understand. And this is actually a reason why I'm actively working on a project that will put those Monte Carlo simulations in the hands of users. I'm in the software realm as well. So if you're interested in that, maybe you can reach out about that. But the being able to run simulations, or at least understand what these tools can do to help you have more success in those financial simulations, that is a really powerful bit of knowledge, and you should internalize that and try to hedge for your financial success in retirement.
Definitely reach out to us if you have questions or concerns about anything we talked about here today. You can also find us on YouTube. Drop a comment in the comment section and we'll respond there as well. We're definitely interested in helping people meet these financial challenges and ensure that we're having the highest likelihood of success when we get to retirement. Next week, we're going to talk about ways to find the funds for your first policy. A lot of people are just getting exposed to the infinite banking concept and the value of high cash value life insurance, and you're wondering how to actually get started. Where do I get the money for that? We're going to have some ideas for you. Be sure to join us for that. Signing off here, I'm James Barber, your Oregon Cash Flow Pro. I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.